Hello, and thanks very much for joining us today, Joe, as part of our Investment Influencers series on ESG. I'd like to start by asking you just to look back at your career and think about what really first attracted you about ESG and sustainable investing, and what's really driven your passion in this area.
Yeah, thank you. A couple of areas really. One is I've always been interested in studied behavioural finance and behavioural science. And that's really shown me that there are certain behavioural biases or foibles that we have that mean we're unlikely to address some of the key and pressing issues around environmental change and societal issues unless we change the way we think and behave. A great example of this is climate change, and what we tend to be bad at is managing risks that are some way off in the future and are not salient to us. So we worry about risks that are present and are close, I guess, like the way we've dealt with the pandemic with quite drastic action. But with climate change, there's been much more apathy despite the risks of that being pronounced as well. So it's made it clear to me that changes are needed to address those types of risks. And I guess the second point is something of a cliche, but having children is a great way for making you think more about the future of the planet and people and what you might leave behind. So those two things together have been motivating factors for me.
I mean, we've seen this huge acceleration in interest and demand for sustainable and ESG strategies, obviously accelerated by the COVID-19 pandemic when it started last year. What's really struck you about this huge transformation we've seen, I mean, especially over the last year?
Well, I think it's fantastic that investors now have an opportunity and see the opportunity to make a material influence on what happens to the planet and what happens to people living on the planet over the decades ahead of us. And I think it's a fantastic opportunity. And also it's about everyone thinking about more than just short-term financial returns. So you can have a very narrow view of performance of funds or portfolios based on what you see on a fact sheet on a quarterly or annual basis. But the returns from investing are much wider than that, and the implications of investment decisions are much more profound than that as well. And I think what we've seen over the last couple of years is investors becoming aware of those issues and wanting to let that influence their investment decision making. And I think this is inevitably going to continue, and that should be good for everyone.
And just in terms of what you've been doing, I mean, obviously everyone knows the MyFolio range there, and towards the end of last year, you launched a sustainable range as part of that. Maybe you could just give us a very brief overview of the thinking behind that launch, and I suppose what advisors and clients were saying to you, and how you responded to that when you launched.
Yeah, absolutely. So the MyFolio Sustainable range is consistent in terms of investment principles and investment philosophy to the existing MyFolio ranges that have been running for over a decade. So they're multi-asset, risk-targeted funds, diversified across asset classes, and they're seeking to deliver returns for clients relative to their tolerance for risk. So those components that have worked over the years are the same. What we wanted to do for the sustainable range was to make sure all of the underlying components that we use within it conform to our sustainability criteria. So that includes avoiding certain companies and certain industries. That means backing better companies, so investing in companies that have funds that have strong ESG processes and outcomes. That will mean investing in funds with better ESG scores, lower carbon intensity, for example, or where they can give good examples of how ESG and sustainability issues have influenced decision making. We also want to invest in funds that are actively contributing to solutions. So by that we mean impact funds where their investment objectives are about more than just financial performance, but also about performance in terms of environmental impact, social impact. And finally, developing engagement is important to us as well. So how are our fund managers using their ownership stakes or their credit relationships with companies to affect positive change? So the underlying structure of MyFolio Sustainable is consistent, but we're applying more stringent sustainability and ESG criteria on the underlying funds that we are choosing within it.
In terms of the risk-graded approach, how does sustainability fit into that? Are there risks that we should be attaching to various strategies that aren't following ESG principles at the moment? How do you sort of fit that in?
Yeah, I mean, it's certainly becoming easier. So there's two aspects here. One is that can we build a sensibly diversified portfolio that's consistent with the client's willingness to take risk? Do we have the available funds and asset classes? And I think we do. I think credit is a little bit behind equity in that, but we still have enough asset classes to build those prudently diversified portfolios. And I think if we think about risk in a broader sense as well, what we're doing with MyFolio Sustainable is encompassing other risks in terms of how we're building portfolio. So those risks, again, outside of volatility or financial risks, but in risks to the planet, risk to the environment, and risk to society through time. So I guess it's a broader view of the risks that investors face, or the implications of the investment decisions that investors might make.
And what are the performance expectations compared to the rest of the MyFolio range? I mean, I presume you're explaining to clients how the profile of these funds may look different from others in the range, and what they may expect.
Yeah, absolutely. So the risk targets are consistent with the other MyFolio funds. There's 5 MyFolio Sustainable funds with consistent risk targets. So broadly speaking, we'd expect the return characteristics to be similar. A couple of key differences though. One is there's less of a UK or domestic bias in MyFolio Sustainable, so that will influence performance. And the other thing is MyFolio Sustainable clearly will have more exposure to high scoring ESG stocks, and also stocks that are in the sustainable or impact investing sweet spot. So the relative fortunes of those companies will affect the relative performance of MyFolio Sustainable against the more broadly diversified MyFolio Sustainable funds, MyFolio funds. But I wouldn't want to make a prediction about that, but I think there'll be a difference because of those factors.
What about the rest of the MyFolio range? I mean, obviously ESG has been integrated across the board now. What sort of changes have been put in place there?
Yeah, absolutely. So in 2 ways, really, ESG is being integrated and becoming more important for the MyFolio funds across the piece. One is that clients care about this, and clients want to know what steps you're taking to address and consider these issues. And also we are seeking to understand how fund managers that we invest with are considering these risks. So they are profound risks that will impact financial performance as well as other factors as well. So we need to take these into account. So we're currently rolling out an ESG rating or scoring system for the funds that we invest in, using our consistent manager research approach. So we look at philosophy, process, people and performance, but through an ESG lens, and then we'll rate the managers that we hold based on that system. So taking a granular approach to manager research, but really drilling down on those ESG concepts to make sure we're comfortable with the approach that our managers are taking.
And what are some of the sort of red flags for you when you're analysing these managers and funds? What are key things that would make you really push back and question those managers?
Yes, I think the major risk from my perspective is, are there risks abound that are being ignored by managers? They're investing in certain sectors or certain funds, and they're not thinking about the risks coming from carbon transition or climate change over the next 20, 30 years, and how that might affect certain business models and industries. So even if you don't have a specific ESG or sustainable mandate, these are factors that are likely to materially impact the businesses in which you're investing. So you need to think about them, you need to assess them, and you need to factor them into your investment decision. So if they're not being considered, then that would be a problem for us.
And what about active and passive funds in the portfolio? What's your approach there, and what's the split in the portfolios?
Yeah, so we use both. So for example, in our equity exposure in MyFolio Sustainable, 75% is in enhanced ESG passive funds, and 25% is in global equity impact strategies. So we think both have a role to play in the portfolios. And there's a few reasons why we like to combine them. One is it allows us to manage costs and balance the low cost of the passive strategies with the higher cost of the high conviction sustainable funds, so keep overall costs low for clients. One is diversification. We know that the impact funds will be much more concentrated and exposed to certain factors. The enhanced passive ESG funds will then blend and balance some of those risks. And the other point to think about as well is, with the enhanced ESG passive funds, they're very much focused on how companies are currently. So good ESG scoring companies now are favoured, low carbon intensity now are favoured. So thinking about present ESG characteristics. Whereas with the impact funds, you're really looking to the future. So companies that are transitioning, companies that are making profound changes to how we might behave or interact or purchase things in the future. So it's that balance of what's happening now and what's happening in the future is why we want to combine those passive strategies and the active impact strategies.
Yeah, yes, that's Yeah, that's very interesting what you're saying there about the passive side in particular. Just in terms of, you've mentioned ratings or scorings quite a bit throughout this, and obviously you do your own work with the team there. What sort of value do you put on the ratings that are out there? There's obviously big discussions around inconsistencies from various ratings providers and what they're actually showing. Is there any that you attach particular value to, or what work do you do there?
Yeah, so I'm of the view that although people talk about the relatively low correlation between ratings providers, and this is necessarily a subjective field. I think friction is probably a good thing, because we don't know all of the answers at the moment. So having friction between what good looks like in certain aspects is probably a good thing, and we'll reach a conclusion as we progress. And the other thing is that the flip side of having different ratings agencies with slightly different views is that you have one ratings agency that sets the entire agenda for what matters in ESG, and I don't think that's a particularly good outcome either. So I think as long as you're aware that this is subjective in many areas, and you need to apply your own analysis to what the ratings agencies tell you, then I think that's fine. And having, again, conflicting views is not necessarily a problem, but you need to understand that the results of one ratings agency is no panacea. So
you would look across the results of a few and then make your own assessments as well?
Yeah, absolutely. So for example, for our enhanced index funds that we use, or enhanced passive funds, they're informed by the MSCI ESG ratings, and so that drives the skews in those passive portfolios. But we wouldn't expect to be reliant on those ratings for an impact strategy, for example, where they're investing in very different types of companies, and there's probably more nuance in the decisions that they're making. So it depends on what you're looking at and what your requirements are.
And what about engagement from the funds in which you invest, both on the active and passive side? What's key for you there when you're looking at those strategies?
Yeah, so it's something that is increasingly important when we talk to managers and when we discuss and compare different passive providers. I think passive generally has been something of a laggard now, but we're seeing far more in the way of commitments from how large passive asset owners will engage. And certainly from a passive perspective, where we're seeing fees fall consistently and it's difficult to compete on fees, then differentiating factors will then become, how can we engage? How are we using client assets to engage and change companies that we're investing in? So I think we'll see more and more from passive providers, and that will become an edge or advantage as people look to decide between passive funds which have fees that are very difficult to separate, and actually track records and tracking areas that are difficult to separate as well. So that will become increasingly important. And I think for active funds, what we want to see is a clear policy of engagement. What are their beliefs? Again, this is very subjective and not necessarily right or wrong answers, but we want to make sure they are engaging, not blindly following management recommendations. And we want to go through case studies with them. What we will do when we meet with managers, tell us about your engagement. Why did you engage? What was the impact and the influence of that engagement? We want to see a pattern of productive and proactive engagement when we're talking to managers.
Yes, that word impact is coming up even more now, isn't it? That's the big focus, is demonstrating examples of what they're doing, not just saying it.
Yeah.
Could you maybe next you could identify a couple of funds you've added to the portfolios recently and explain why?
Yeah, sure. So perhaps it would be good to give a couple of examples of the different types of equity funds we invest in. So we've recently invested in the ASI Sustainable UK Equity Index Fund, which is an enhanced UK equity market tracker. So it aims to have a low tracking error relative to the UK equity market, but with improved ESG sustainability criteria. So better ESG scores from MSCI ESG ratings, 50% lower carbon intensity, a higher level of green revenues, and certain exclusion applied as well to areas like tobacco. So it gives you broad market exposure, but with much better ESG characteristics, and that type of exposure is a really key building block for how we put MyFolio Sustainable together. On the flip side of that, we use 4 equity impact strategies to complement the more diversified passive exposure. One of those is the Pictet Global Environmental Opportunities Fund. So Pictet have been doing this kind of specialist type of investment since 1995. the Global Environmental Opportunities Strategy, launched I think in 2014, but they've been running specialist water strategies, clean energy strategies from before then as well. So it's important to us to invest in a group that has pedigree in this area rather than just latching onto a trend where there is good performance and strong flows. And they're quite innovative in their approach as well. So they use the Planetary boundaries framework in their investment universe. So that looks at what the environmental limitations of the planet, and covers areas like climate change, ocean acidification, biodiversity, freshwater use. So this is a framework that was developed in Stockholm by a group of scientists. So all of the stocks that they invest in must have a product or service that materially impacts one of those planetary boundaries in a positive way. So they invest in areas like power storage and pollution control, sustainable agriculture. And so they have a very clear impact process. We understand what types of impact they're looking to achieve. We can understand what stocks are linked to which type of impact. And then when we meet with the managers, we can talk to them and address specific case studies and see, do we believe the impact story? Are they having an effect? And I think that's really important, because measuring impact is very difficult. It's improving, but it's really difficult to do on a consistent basis. So understanding the process and being able to speak to the managers about impact on a case-by-case basis is vital, I think.
And just finally, perhaps you could share what you'd like to see now from the industry in terms of the evolution of sustainable and ESG investing. What are key things that you think we need to be focusing on now?
Yeah, I think there's a couple of key areas for me. One is that it needs to be a genuinely long-term commitment, not a temporary phenomenon to raise assets. So asset managers need to support and back this for the long term. Clearly, there are pressures around short-term performance and flows for asset managers. And we know that there will be periods where ESG or sustainable strategies might struggle. Investment returns are cyclical over the short term. So if those tailwinds abate for a period, we need to know that they'll still be supported. So there will be tests in the future when the tailwinds won't have been as strong as they have been recently. And the other key point is about measurement and reporting. Everyone's very keen to evidence their sustainability credentials, their ESG credentials. This is very difficult to do in a robust and consistent way at the moment. And I think the danger is that asset managers broadly end up reporting what they can and set targets just because they think they can meet them, rather than they are the best way to measure something or they do particular long-term good. There's an old adage called Goodhart's law, which says that once a measure becomes a target, it stops being a useful measure, because everyone just focuses on hitting that target irrespective of what it means or whether it's particularly important. So you can think about something like carbon reporting and trying to measure only scope 1 and scope 2 and that emissions, and that is your target, and then you beat that target, so that's okay, but you forget about scope 3 emissions in the value chain. So we need to understand that, yes, we need to improve measurement and we need to report, but it's a difficult area. So let's not set targets on the wrong things, and let's make sure we take some time to get the measurement and reporting right.
Yeah, that's a really good point, and some good things to consider as this industry continues to evolve. Well, thank you very much for your time with us today. I hope to see you again soon. Thank you.
Yeah, it's been a pleasure. Thank you.